Welcome to today's Explainer. We are jumping right into a high-stakes reality that pretty much every innovative company has to face at some point, and that is, how do you legally treat your innovation costs without triggering one of those dreaded SEC comment letters? I mean, think about it. When your teams are pouring literally millions of dollars into developing next-generation tech, the way you handle the accounting for those dollars can radically alter your balance sheet. Get it right, and you're accurately reflecting your company's true value. But get it wrong, well, you might find yourself navigating an absolute nightmare of a restatement. So today, we're unpacking the strict guidelines of the Accounting Standards Codification, specifically ASC 350-40 and ASC 730, along with general GAAP rules, to show you exactly where those lines are drawn. Here's our roadmap for today. We'll start off with the R&D capitalization trap, move into software's three-stage model, dissect the strict rules around general R&D, explore some rare exceptions for acquisitions and tax, and finally, finish up with the red flags you absolutely need to watch out for. All right, let's dive right into Section 1, the R&D capitalization trap. So, I want to kick off our investigation with a deceptively simple question. Is your innovation an asset, or is it just an expense? There is this constant underlying tension between what companies naturally want to do and what US GAAP actually forces them to do. It's like a giant tug of war. Business leaders, of course, want to view their innovation spend as an investment, right? They see it as an asset that builds value for the future, so they want to capitalize it. But GAAP takes a much more conservative, skeptical view of these costs. And understanding how to navigate this tension is absolutely crucial for the integrity of your financial reporting. To see what happens when that rope snaps, let's look at case scenario D from our source material. Imagine a company that improperly capitalized its internal R&D costs as an intangible asset straight from day one of a project. Guys, this is a massive red flag. By doing this, the company is wildly overstating its intangible assets on the balance sheet and dramatically understating its expenses for the current year. Basically, it makes the company look artificially profitable in the short term while quietly hiding future amortization expenses. This is a textbook high-risk violation of ASC 730. Moving right along to Section 2, software's three-stage model.
Now, you might be wondering, wait, isn't there any way to capitalize development? Well, yes, but you have to be playing in the right sandbox. Software development offers one of those rare paths, and this GAAP rule brilliantly illustrates where the line is. Basically, internal software development moves through three very distinct stages, and the accounting treatment literally flips depending on where you are. Step 1 is the preliminary project stage. This is your feasibility studies, vendor evaluations, conceptual design, all of that. It must be expensed as incurred. It's essentially just R&D. But then we hit Step 2, the application development stage. This is where the actual coding, functionality testing, and data conversion happen. Only costs in this specific stage get capitalized. And finally, Step 3 is post-implementation. We're talking training, maintenance, basic bug fixes, back to expensing. The tracking here has to be exact, and it's usually backed up by official project stage determination memos.
But the narrative shifts significantly when we move to the cloud. Under ASU 2018-15, if a cloud computing arrangement includes a software license that the customer actually controls, well, that license is treated as an intangible asset, and the implementation follows that same three-stage model we just talked about. But what if it's a hosting-only SaaS arrangement where there is no software license? Then it's treated as a simple service contract with no asset recognized at all. However, and this is a really crucial nuance, even in a hosting-only setup, those Step 2 implementation costs might still be capitalizable. It's a tricky little carve-out, so it requires some really careful analysis. So, let's say you've successfully capitalized those Stage 2 software costs. Awesome. But they don't just sit on your balance sheet forever. Capitalized enterprise software typically has a straight-line amortization useful life of 3 to 7 years. That amortization begins the exact moment the software is substantially ready for use. And just like your standard property, plant, and equipment, these assets are totally subject to impairment testing if a triggering event ever occurs. Okay, let's pivot to Section 3, the strict R&D rule. So as we saw, software gives us a narrow little path to capitalization. But what about non-software R&D? Well, what's fascinating here is the global contrast. Over here, under US GAAP ASC 730, the rule is brutally strict. You must expense all internally generated R&D costs the moment they are incurred, no exceptions. But if you look across the pond at international financial reporting standards, specifically IAS 38, IFRS actually allows companies to capitalize development costs if they meet certain criteria. US GAAP, it leaves absolutely zero room for that. If it's internal R&D, boom, it hits your income statement immediately. And because the US GAAP rule is so incredibly strict, you really have to know exactly where the boundary lies. You need to be able to visualize the definitive line between R&D expenses and commercial production costs. Laboratory research aimed at discovering new knowledge, testing prototypes, designing pre-production models, all of that qualifies as R&D and has to be expensed. But what about routine, ongoing alterations to existing products? Or market research? Or quality control testing during commercial production? Those are not R&D. Remember, GAAP doesn't distinguish between research and development for internal projects. They are both just expensed. The true accounting boundary is crossed the second you move out of R&D and into commercial production. This brings us to Section 4, Exceptions for Acquisitions and Tax.
Okay, so we've established that internal, non-software R&D is generally an immediate expense. But let's explore a very rare exception. The biggest exception actually happens during a business combination, an acquisition. When you acquire another company, their in-process research and development, or IPR&D, is treated completely differently than your own internally generated R&D. Acquired R&D is actually recognized as an intangible asset at fair value on the date of the acquisition. And here's the crazy part. It remains an indefinite-lived asset until the project is either completed or abandoned. Only at that point does it become a finite-lived asset or get written off.
The other major twist comes from everyone's favorite agency, the IRS. While ASC 730 forces you to expense internal R&D on your books right away in year one, the IRS actually requires you to capitalize and amortize those exact same costs for tax purposes under IRC Section 174. For domestic R&D, you amortize it over 5 years. For foreign R&D, it stretches out to 15 years. This creates a really significant deferred tax asset because you're recognizing the book expense immediately but taking the tax deduction slowly over a long horizon. It's a classic book-to-tax difference, and it requires some seriously meticulous tracking.
Let's wrap things up with Section 5, Red Flags and Industry Impact.
So let's bring this whole investigation to a close by outlining the ultimate game plan for companies, especially those of you in the fast-moving tech sector. If your company has accidentally fallen into the trap of capitalizing internal non-software R&D, here are the exact steps you need to take. Consider this your actionable toolkit. First, you have to immediately write off all those improperly capitalized R&D costs. Second, assess if that amount is material enough to require a financial restatement. For SEC registrants, that means doing a rigorous SAB 99 or 108 analysis. Third, moving forward, you have got to implement a strict 3-stage tracking process for any software development. And finally, enforce an uncompromising policy that all non-software R&D is expensed as incurred, period. I really want to hammer home this quote from the source material because honestly, it belongs right at the top of your high-level risk register. R&D costs capitalized internally indicates an ASC 730 violation. All internal R&D must be expensed. The root cause for this is usually just a misunderstanding of the rules, right? But the impact is severe. We're talking overstated intangible assets, understated expenses, and a very, very high likelihood of receiving an SEC comment letter demanding a correction. So, I'm going to leave you with this final thought to help you evaluate your own KPIs. In the tech industry, R&D expense as a percentage of revenue is a totally critical metric to measure your investment in innovation. But you have to ask yourself, is your metric driving true innovation, or is a misunderstanding of ASC 350/40 and ASC 730 masking a massive audit risk? Just make sure your accounting practices reflect the reality of the GAAP rules, not just the ambition of your projects. Thank you so much for joining us for this explainer, and we strongly encourage you to go dig a little deeper into your own cost classifications today.